let me paint you a picture. And it starts with some fantastic news. It starts with some fantastic news because there's been an earlier than expected rise in interest rates, and that's pushed gilt yields up by 0.5%. And that's wiped £120 billion of pension fund deficits. But guess what? Good news brings more good news. Recovering oil prices and strong bank earnings mean that the equity market goes up by 5%. And that takes another 20 billion of deficits. Meanwhile, though, Jim O'Neill's worst fears come true, and bacteria become completely resistant to antibiotics. The UK's average life expectancy of 81, the 20th highest in the world, falls 2 years. And that puts us on a level playing field with the USA, with Qatar, and with the tiny Micronesian state of Nauru, with its population of just 10,000 people. But it wipes another 105 billion of deficits. Now, resistant bacteria may not be very pleasant, but it does all start to paint a pretty positive picture for pensions, because suddenly, poof, 179 deficits have gone, vanished, disappeared, washed away. Now, at this point, I can see one or two of you reaching for the Nurofen thinking, crikey, I really did overdo it last night. And by the looks of one or two of you, I think you could be right. Others of you are thinking, blimey, she really is off her rocker. And to be honest, you wouldn't be the first to have said that. But the art critics amongst you, well, you're thinking that as a picture of the UK's pension scene, that really is a load of Jackson Pollocks. Because life just isn't like that, is it? The chances of any one of those things happening are pretty remote. But the chances of all of those things happening together, well, even the non-actuaries amongst us like me know, the chances are infinitesimally small. So instead, here's the cold, hard reality of where we really stand. And if you did overdo it last night, I can tell you it's a pretty sobering picture. At the end of January, so the deficits today aren't the 250 billion that I talked about where they stood at the end of January. They weren't even 305 billion, which they were a few weeks ago. Just 48 hours ago, the PPF published their latest 7800 index, and that put deficits at 323 billion pounds. Almost 5,000 pension schemes are in deficit. Now, look hard enough and you will actually find someone who's going to tell you that gilt yields are about to go up by 0.5%. But in January, yields on 15-year conventionals fell by 34 basis points and on linkers by 20 basis points. Tomorrow, the ECB's Central Governing Council will meet. And as we know, its rates on deposits are currently at minus 0.3. And commentators are confidently predicting that rates will fall further by between 10 and 20 basis points. And it doesn't seem likely, does it, that the Fed or the Bank of England are about to raise rates from beyond 0.5% anytime soon. In fact, every time the MPC meets, the prospect of a rate rise becomes more and more distant. I kind of think of it as being a bit like my relationship with the basic state pension. You know, the older I get, the further it gets away from me. We should perhaps, though, be reassured by the fact that Governor Carney has said he won't take interest rates to below zero. But he has said he'd be prepared to cut to zero. Now, for those of us with mortgages, that might be pretty good news. But I call it pretty cold comfort if you're running a DB pension scheme. And the challenges don't stop there. Talk of a European banking crisis, a second European banking crisis, are getting louder and louder. Shares in Deutsche Bank, in Santander, in Credit Suisse, RBS and Barclays all fell sharply over the last month. The FTSE All-Share Index fell by 3.4% over the last month. and the FTSE 100 fell by over 15% over the last 12 months. And oil prices keep dragging the market down. Just a couple of weeks ago, oil prices fell by 5%, and that wiped 1.5% off the FTSE in a matter of hours. Now, a 5% increase in equities could happen. We know it's a volatile market, and we're the first to point out that markets go down as well as up, and that we're long-term investors here for the long term, here to ride out the waves. But I think you'll agree with me that volatile is about the best description and the most positive description we can give to the markets right now. And added to that, of course, we're all living longer. Just over the last couple of weeks, there have been some fantastic scientific breakthroughs announced. First of all, we saw scientists announce a breakthrough in a cure for some cancers, and that will be tremendously important to those people suffering from that cruel disease. And hard on the heels of that, we heard scientists announce that they discovered a 10-minute blood test that could tell you about all your hereditary heart diseases. So it's no wonder that the UN are predicting that there'll be 1 billion more people on the planet within the next 9 years. A third of that will come from the over 65s, the people drawing benefits from our pension schemes. Did you know that in Japan, 400 schools close every year because the population is rising so rapidly that there simply isn't any need for them? And that a child born in this country in 2014 will, on average, live for an extra 10 weeks longer compared to one born the year before. And here's a quick quiz for you. How old do you think you'd have to be to have a 50% chance of dying next year? Now, I'm not going to get you rushing for your devices, and I'm not going to put it up on the screen. But we did run this quiz around the office. Some of us said 80, a few said 90, some even stuck their necks out and said 95. But we were all wide of the mark because the answer is 108. Seriously, 108. So in the absence of any catastrophe, life expectancy isn't about to fall by 2 years. The 200 most mature DB schemes might be okay. They're funded at 118%. But those schemes with 50% or more of their liabilities attaching to actives and deferreds, well, they've got a £250 billion hole to fill. So gilts, equities, longevity, so far so challenging. But meanwhile, we've got a wave of huge global megatrends coming our way. Global mobility will increase by 50% by 2020. The effects of that on welfare, on housing, on healthcare are all there to be felt, and felt by our pension schemes. In 4 years, the majority of children born to mothers in North America and Europe will be born to women aged over 30. Those children will be healthier and they'll live longer, and in turn their children will be healthier and live longer. And so it continues. 50% of the world's population growth by the middle of this century will come from Africa. And who can forget Bob Geldof talking at our conference 2 years ago, and I won't use the language that he used at this time of the morning for sure, but who can forget Bob Geldof talking about our conference and talking about that huge shift in consumer power from the developed world to Africa. Now, last October at our annual conference, you will have heard me launch our new name, the Pensions and Lifetime Savings Association, and our refreshed purpose. Well, alongside our new name, we have a new set of values. And one of those values is to be optimistic. And you heard from Leslie yesterday that we've got a lot to be optimistic about. 6 million new pension savers coming into pensions for the first time. That's tremendously important, and it should give us cause for optimism. But sometimes that can be hard, can't it, to be optimistic when we're faced with data like the ones I've been talking about. And it's not just us who find it challenging. A recent poll of association members found that most schemes too were finding it quite difficult to be optimistic about the prospects for the next year, as well as the 5 years beyond that. Now, back in October, I said that our new name and new direction would enable us to deal with the challenges that lie ahead. But I was also clear that we can only deal with the challenges that lie ahead if we confront the challenges that we have today. Today, funded DB schemes across the public and private sector have 16 million members and over £1 trillion worth of assets. They're the economic powerhouses in this country, fueling investment in the real economy, fueling investment in infrastructure, contributing to jobs and growth and prosperity, which leads to a stronger economy, which leads to stronger companies, and which lead to stronger pensions. So in the context of all that turmoil, what can we do to make sure that those schemes can carry on delivering? Now, we can't confront all of those issues by ourselves, and I'm certainly not about to suggest you take tackling the longevity issues in your own schemes into your own hands. That's likely to land you in hot water. But there are some interventions that we can make, and there are interventions that do lie in the hands of the people who make workplace pension schemes work. I'm talking here about government, about regulators, trustees, scheme managers, advisors, and of course us as your association. And I think there are probably 4 areas of inquiry and potential intervention. First of all, what can we do to make markets work better? And by that I mean, how can we make sure that markets work and are aligned with our interests as long-term investors? And how can we make sure that we get the data that we need to make sure that markets are aligned with our interests? Secondly, regulation and the way in which that drives behaviour, which at first blush may not always seem particularly logical. Thirdly, what can we do to make DB more efficient? Are there structural challenges and changes we should consider? And lastly, what can we do ourselves to make things better and to make a positive difference? Now, I'm not going to give you the answers today. I'm just going to throw out some challenges and ask some questions. I want to start a debate. Now, you might say to me, well, come off it, Joanne. This is a debate we should have been having 10 years ago. And you'd be right. We should have had that debate 10 years ago, and we were having that debate 10 years ago. But we didn't see action from government, and we didn't see action from regulators. So we need to have that debate again now, and we need to see action from government and from regulators now. So I would throw out some questions. I want to start a debate, and then I'm going to talk to you about how we might start to find the answers. So starting then with markets and what can we do to make markets work better? Well, yesterday you heard from Tracy McDermott from the FCA, and you heard about their study of asset management. And we welcome the FCA's intervention. It's a very important study, and I do urge you to all engage with the FCA's work. It's asking some very important questions about how markets work, and it's asking some very important questions about the value chain. And you'll know that that's been something which has concerned us for a long time. Now, I mentioned that we ran our own survey of members just before coming up here to Edinburgh to meet with you all this week. We wanted to really sort of test the temperature, get your views of how things were working. Well, the good news for Tracy and her colleagues is you thought things were working pretty well. 88% of you, in fact, said that you thought your managers were acting in your interests. 96% of small funds said that too. So far, so good. But what happens if we scratch beneath the surface a little bit? Do we start to see a slightly different picture emerging? Last year we did some research, and it gave us some very interesting results. It showed that you could buy almost identical global equity mandates for between 45 and 90 basis points, so twice the price for effectively the same product. And before you ask, we did take account of returns in all of that. For active real estate, the differences were even starker. Anything between 32 and 200 basis points for the same product. So perhaps we shouldn't be quite so sanguine. Perhaps we shouldn't just be quite so ready to accept the way that things currently are. We have to ask if we can change the way we invest, and we have to think about how funds make investments and the risks they take and how they take those risks. Our survey found that most funds won't change their attitude to risk when markets are falling. And if they think they will change it over the next few years, it will be to become more risk-averse, not less. Now, that may be perfectly rational. That may be the perfectly right thing to do. But in other occasions, in other schemes, maybe it's not. So we have to understand more about how schemes take risk, their attitude to risk, their understanding of risk. And we need to ask how we might start to rebalance that. Now, some of that risk aversion that I spoke about comes from regulation. Our survey told us that regulation makes a third of large and medium-sized schemes more risk-averse than they might like to be. The regulations that changed behaviours most were the TPR codes, accounting standards, and the PPF levy, you told us. Now look, let me be absolutely clear at this point that none of us at this association, least of all me, want to see members' benefits put at risk. But perhaps it is time for a rethink. So where might we look? Well, here are some wise words for starters. Current accounting standards have been very damaging to defined benefit provision, leading many companies to close their schemes. Pension funds are long-term institutions, but today's accounting standards fail to recognise that. That was our former chair, Lindsay Tomlinson, on this stage at this conference 6 years ago. His words were right then, and they're right today. But there are other regulations that lock in inflexibilities for schemes. More than one scheme has said to me that they don't think that 3-year triennial valuation periods are right, that longer periods would actually enable a more sensible and more rational approach to investment. And if we're thinking the unthinkable, as Frank Field would say, then is there scope to think about how we could rebalance liabilities? Now, I'm not suggesting any of these are the right answers. I'm just throwing out the questions, starting that debate. Because, of course, one consequence of regulation is that it limits schemes and trustees' room for manoeuvre. And that then leads to accusations that schemes are just following the herd, sort of mindlessly following herds, when, of course, nothing could be further from the truth. So a more flexible and more mature regulatory approach could help schemes become more efficient and could help schemes become more sustainable. So what about changes and structural changes to schemes themselves? Perhaps part of the answer lies there. Our colleagues in the local government pension scheme are currently teaming up to create giant pools of assets, creating pools of 25 billion or more, 6 or 8 of those giant funds, rather than 89 separate funds. So the investment efficiencies are there for the taking. So, question, is that something that could be replicated in the private sector? Of course, we've got our own example of asset pooling in one particular asset class through the pensions infrastructure platform, and you will have seen the launch of that yesterday. Already with £1 billion committed to UK infrastructure projects, it's already saving participating funds millions in asset management costs. And it's providing direct access to infrastructure for smaller funds where that simply wouldn't be possible otherwise. So we need to explore the possibilities of pooling and other structural interventions. Could we go further and think about what that might look like on the liability side of the equation? So far, I've talked about external interventions. But we have to ask ourselves what we can do ourselves to make schemes work better. And I think we have to have some pretty honest conversations with ourselves about where the deficiencies are. We've made some very important strides forward in improving pension fund governance over the last decade, and I'm always the first to say that. But if we're honest with ourselves, we know that there's more we can do, we know that there's further to go. So we need to think about how we can improve the quality of governance and how we can help improve the quality of the people who are running those schemes, who are responsible, who are the stewards of those schemes. Could there be a case for firmer action for trustees who don't come up to the mark, for example? And that's the last question that I'm going to ask, because now we need to start to find the answers. And that's work that starts right now. So today, I'm delighted to announce the launch of our DB task force. Task force is set up to tackle the problems faced by DB schemes and to try to find some solutions to help make defined benefit pension schemes more sustainable. I'm delighted that ASHOK GUPTA, who was previously the co-deputy chair of the Bank of England's inquiry into procyclicality by pension funds and insurance companies, has accepted my invitation to chair the task force. And he's going to be joined by experts from across the industry and academia. The task force will report into our very, very active Defined Benefit Council and onto the board. Its job is to articulate the challenges that DB pension schemes face today in a much more detailed way than I've been able to do over the last few minutes, and to start to set out some of the solutions to ensure that DB schemes are sustainable for the long term. Now, the task force can only do its job if it's got your support, if it's got your engagement. So it's going to be out and about speaking to schemes of all sizes, speaking to trustees and their sponsors, speaking to regulators, speaking to government, speaking to intermediaries, to really start to understand what's going on inside DB. I've asked the task force to report by October in time for our annual conference, and you'll be able to hear the results of their work at that conference. So my final words this morning are to ask each and every one of you in this room and beyond to contribute to the work of the task force. And you can start that right now, because we're putting a question on Twitter, and we know from Tim Berners-Lee yesterday, or following Tim Berners-Lee's questions yesterday, you're all completely engaged with the web every second of the day. So here's the question that we're putting up on the website. If you could fix one thing for DB, what would it be? And you can reply with the hashtag DB Task Force. Now, when you think about the answer to this question, and you think about your 140 characters, I want you to go back to that new value that I talked about earlier, that value to be optimistic in thinking about how we deal with this issue, how we solve the issues that we face. Because it'd be really easy, facing this kind of question, to just be fatalistic about it. But that will be the easy way out. And we're not really interested in the easy way out, are we? We're interested in finding the right way forward. So if we work together, I know that we can find the right answers. I know that we can make a difference. Thank you very much.